This is your host, Lauren of the Adulting is Easy podcast, where we make adulting easier by making money easier. Please take a second and hit the follow button wherever you're listening and leave a review as well if you can safely do so if you haven't already. I'm joined today by Brian Feroldi, an author, speaker, YouTuber, and financial educator. He loves to help people do better with their money. Thanks for joining me, Brian.
Thanks for having me, Lauren.
Our goal for today, Brian, is to make adulting a bit easier for listeners by discussing a personal finance topic, since managing money is a big part of adulting. So today, we're going to talk about the stock market. And since you literally wrote the book on the stock market, why don't we start with what actually even are stocks?
Yeah, that's such a fundamental question. And it's a term that gets thrown around in the media so often. I actually think it's really helpful to back up and just answer that question at the start. What the heck is a stock and why does it exist? Well, one reason to say that why it exists is to come up with a quick example. So Lauren, let's see that you and I were going into business together. We were going to open up a candy store, and we said that we thought that this candy store needed about $100,000 in capital to get going. Well, Lauren, you're flush with cash and you say, Brian, I'm going to put $90,000 to this project. I say, okay, I can only pony up $10,000, but that gets us to the $100,000. Well, how are we going to keep track about who owns how much of this venture? You're putting up 90% of the capital. I'm only putting up 10% of the capital. This is why stocks were invented. Stocks represent fractional ownership of a corporation. They are essentially a record-keeping tool for figuring out who owns how much of any given business. So again, for simplicity, let's just say that our business has 100,000 shares. We arbitrarily price them at $1 per share. These are made-up figures, and they could be whatever we wanted to, but for simplicity, that's what we're going to go with. So you invest $90,000. Congratulations, you now own 90,000 shares. I invest $10,000. I now own 10,000 shares. And whenever the business makes a profit, we can divvy up the profits easily by using these record-keeping tools called stocks. So that is what a stock is. It represents fractional ownership of a company.
That was so well said. So is Brian and Lauren's candy store on a stock market then, or not?
Yeah, this is also something that really confused me. I thought that the only way that you could have stock was by being a publicly traded company that you could go out and buy. So I thought that like only Apple and Microsoft and Amazon had stock. That's not true. In truth, any corporation that is founded has stock, and that stock, again, controls who owns how much of any given company. The stock market, the vernacular that we use in common parlance, simply represents the companies out there that chose to list their stocks on a public stock exchange. In doing so, they would allow anybody with capital to invest or buy fractional ownership of those businesses. So when we refer to the stock market, what we're talking about is the thousands of companies out there that are listed on the public exchanges. Now, to go one step further than that, how do we track how these public exchanges are moving? Well, there's three commonly used indexes that track the rough movement of the stock market indices to give an indication for what's happening with all the stocks that are out there. The most three popular stock market indices in the world are the Dow Jones Industrial Average, the S&P 500, and the Nasdaq 100. Each of those just represents a subset, a fraction of the companies that are out there, but that's what we mean when we say the stock market.
Love it. So Brian and Lauren's candy store, in your example, I come up with 90 grand, you come up with 10. That's a privately held company. Why would we want to take our company to one of these exchanges? Why would we want to go public?
That's a great question. Yeah, why can we go out there and become part owners of Facebook, for example, or any of the thousands of companies that are out there? By and large, there's a few reasons that a company goes from being a private company to being a public company. The number one reason that a company does that is because when a company lists its stock on a public exchange and sells those stock to investors, it gets a huge amount of cash for making that transaction. So let's go back to our example. We have 100,000 shares in total, and we bought them for $1 each. Again, those were made up numbers. Let's say that we want to grow our business and we want to open up a second store and we need another $100,000 in capital. Well, we work with some fancy bankers and they say to us, well, we think you can price your stock at $10 per share. We think there's investors out there that will buy Lauren and Brian's coffee shop at $10 per share. So in order for us to raise $100,000, our company would create 10,000 new shares of stock, list them on a public exchange. Investors would buy that stock for $10, and our company, in doing so, would get a $100,000 check up front. So that is the number one reason that companies go public. They want to raise capital, they create new shares of their stock, and they list them on a public exchange. And in doing so, in exchange for letting outsiders invest, that company gets a big a bolus of money. That's thing one. Thing two is that insiders, the people that already own the stock, such as you and I, now have a very easy and convenient way for us to convert our existing stock into cash, should we choose to do so. Stocks that trade on the major exchanges trade up and down every day, every business day. And it would be relatively simple for us to take my 10,000 shares or your 90,000 shares and sell off a fraction of them to the public market. That's much harder to do when those shares are privately held and you literally have to go out and find a buyer to do so. Third is when a company becomes public, it's almost like a marketing event for the business. Now that there's outsiders that can own it, all of a sudden the investment community starts paying attention to that company, and that can help to elevate its level in the business community. It can also help with recruiting. It can also help with finding customers, especially if that investment does well. So those are the main reasons that company go public, but the number one reason by far is because the company gets money for doing so.
And then what do they do with that money?
Well, typically when a company comes public, as part of that process, they have to produce this really long document called an S-1. And that basically lists out everything you could possibly want to know about investing in the business. As part of that, they do have to state up front what they're going to use the capital for. So in Facebook's case, for example, when Facebook came public, I'm pretty sure the year was 2012, they were a rapidly growing company. So they were hiring like crazy to find engineers to continue to build out the site. They needed servers, they needed HR people, they needed corporate offices, etc. So they needed capital in order to continue to fund the company because it was growing so quickly. So Facebook came public in order to basically fund that expansion that it had in mind. Other companies might come public and say, we're going to use the capital to pay off our debt. So wipe debt off the books. Other companies come public and say, we're going to pay out our initial investors. That's not a great reason to come public if you're going to be buying that stock, but if that's going to be happening, they have to disclose that up front. So there's numerous reasons that companies want cash, but they do have to tell you before you make the investment what they're going to do with it.
That is so fascinating. So when you were talking about publicly traded companies and how do we track what the stock markets are doing, you talked about the Dow Jones, the S&P 500, the Nasdaq. Can you tell us a little bit more about what those are? Because those are things that we see all the time. And I just want people to have a better understanding of literally what especially those three are.
Yeah, let's start and talk about the history of the Dow Jones Industrial Average, because I think once you learn a little bit more about that, everything else kind of falls into place. So rewind the clock to the 1890s. The 1890s. Back then, just like today, there were publicly listed companies out there that investors could invest in. And the leading newspaper at the time was called the Wall Street Journal. Now, how did investors find information about stock prices or what was happening in the markets? The answer was they read the paper. Well, a guy named Charles Dow was the editor of the Wall Street Journal. And his paper was just printing tables and tables of stocks and their price changes on any given day. And Charles Dow was looking for a way that he could summarize for his readers what happened in the stock market that day. On any given day, some stocks were up, some stocks were down. So there wasn't a narrative that he could tell his readers to say, here's what the mood on Wall Street was today. So he talked with his friend and a statistician named Edward Jones, and the two of them came up with a solution. What they did was they added up the dollar price of the 12 largest and most commonly held companies at the time, and then they divided the total by the number 12. Now, what's it called when you add up a whole bunch of numbers and then divide by the number that you added up to? Well, that's called averaging. So they invented the Dow Jones industrial because most of those 12 companies were industrial businesses, average. So the Dow Jones Industrial Average, all of a sudden, Charles Dow had a number that he could report to his readers and show how the number changed from day to day, from week to week, from month to month. And that number would reflect what was happening in Wall Street on the stock market on any given day. And we've been tracking that number every single business day since 1896, and it has since become the most popular way to figure out what's happening in the stock market in the world.
That's incredible. And it has changed over time, right? We've gotten to, I think it's 30 companies, and those 30 companies change over time. But that is so incredible that Dow and Jones were so forward thinking about this. And then, so now we also have, so we have those 30 companies now. And the idea is that those 30 companies are a representative of the entire market, right? But we also have the S&P 500. And what is that? I'm assuming is there 500 companies in that?
That's a really good assumption. Yeah. So I think it blows a lot of people's minds. It blew my mind when I learned that the Dow Jones Industrial Average, this number that's reported that seemed to be so popular, is literally just 30 businesses, right? There are thousands of companies out there. How the heck could just 30 of them represent what's happening in the stock market on any given day? But that's exactly what happens. Well, in America, we are a capitalist society, and whenever somebody creates a good idea, you can be darn sure another company is going to come along and try and copy it. So in the year 1923, a company called Standard Statistics created an index of their own. And they launched this index with 233 companies. That was way more than the Dow, and that's how they stood out. They said the Dow only tracks 30 companies. We're going to track 233 of them. Well, over time, Standard Statistics merged with another company called Poor's Publishing, giving birth to the Standard and Poor's Company. And then in 1957, in a way to really one up the Dow Jones Industrial Average, they expanded their list from 233 companies to 500 companies. In doing so, they have since become the most popular way to track what's happening with the market, and a lot more mutual fund manager and hedge fund managers actually track their performance against the S&P 500 because it owns so many more companies than the Dow Jones does. But that is how the Standard & Poor's or S&P 500 came to be. It was looking as a way to compete with the Dow Jones.
Good old-fashioned competition. And what about the Nasdaq? Did somebody say, okay, I want to do something in the middle?
Well, so the Nasdaq is a little bit more of an interesting story. Actually, all these stories are kind of fascinating if you like the history, like I do. So the Nasdaq was given birth in 1971. Now, why 1971? Well, at the time, it was really hard. It had always been a challenge previously to get accurate stock pricing information to all market participants at all time. You can imagine that the trading most happened on Wall Street in New York at the exchange, the New York Stock Exchange, and they had a problem getting that instantaneous pricing information out to the rest of the country. right? There were people that wanted to buy and sell stocks, but there was a huge delay between them getting the most recent stock information and what was happening on Wall Street. So there's an overseer of stock prices called the National Association of Security Dealers, the NASD. And what they did is in 1971, they launched the world's first computer-driven stock exchange. So rather than people having to exchange pieces of paper and money with each other in person, computers were advanced enough at the time that this could be done using computer networks. And this would solve the problem of getting those stock quotes or stock prices to all market participants at the same time, because it could be done electronically. So the National Association of Security Dealers named this thing the National Association of Security Dealers Automated Quotations being synonymous with the word quote or stock price, or the shorthand is NASDAQ or Nasdaq. Now, a lot of companies, especially tech companies, liked the idea of listing their stock on an electronic exchange because it gave all investors the exact same information at the same time. So this is why a lot of tech companies in particular, such as Microsoft, such as Adobe, such as Intel, chose to list their stocks on this new electronic exchange instead of the old-fashioned New York Stock Exchange. Now, when the Nasdaq was launched, it was a major revolution in the marketplace, but they also needed a way to track all of the stock prices or summarize all of the stock prices that were taking place on this new exchange. So they gave birth to the Nasdaq Composite, which was just an amalgamation of all of the stocks listed on the Nasdaq exchange and what's happening with their prices. So that's why you see in the news these three major stock indices reported all the time. The Dow Jones Industrial Average, which is the oldest one and the simplest one. The S&P 500, which was made in the 1950s as a way to compete with the Dow. And the Nasdaq, which is the newest one, and this one was launched in the 1970s.
I can't believe you know all that off the top of your head. It's pretty awesome. So why should people care about stocks and the stock market and what it's doing?
Yeah, that's a completely fair question. I can tell you that when I was growing up, whenever like news came on about the stock market, or I saw the news reporter talking about it, or I saw it in the paper, my brain just immediately switched off. Like, so what? Some prices or some numbers are moving up and down on a screen randomly. Some days they're up, some days are down. Why the heck should I care at all about this thing that seems to in no way affect my life? The reason that people should care about it is I truly believe that the stock market is the greatest wealth creation machine of all time. The stock market literally allows people with ordinary incomes to turn modest investments into life-changing amounts of wealth over time. Real simple example I show in the book. I make up a fictional character named Aaron. Aaron's career starts in 1981. Aaron invests about $400 per month into the stock market, the U.S. stock market, and he just earns an average return. Aaron never looks at his statements. He throws them away. How much money does Aaron have 39 years later when he retires in 2020? Well, Aaron invested $400 a month for 39 years. That's $192,000 invested. And yet at the end, he ended up with $3.013 million. So he literally got more than a 15x return on his investment over that 40-year career. Doing so, he earned a return of just over 10% per year on average, which is pretty close to the historic rate of return of the U.S. stock market. But that's why people should care about the stock market. Broadly speaking, the U.S. stock market has gone up nominally about 10% annualized return over the last 150 years. If you want to do that after inflation, the returns after inflation are about 7%. But this is why so many people, so many rich people in particular, keep so much of their wealth in the U.S. Stock market. It delivers a relatively predictable return when measured over the appropriate period, which is decades, not days.
Yeah, let's talk about that. So, so the average return is 10%, but if you ever look at historical returns by year, it's almost never 10%, right? It's like negative 30 plus 30, then it's 14, then it's negative 2, then it's 3, whatever it is, right? It's almost barely ever actually 10%. So why is that? Why is the stock market so volatile?
Well, yeah, this is what scares and so many people don't understand about the stock market. I myself didn't understand this about the stock market when I first invested. Like you said, all I saw was like a number going up and down. And if you've ever seen the long term returns of the S&P 500, you do know that it's a chart that goes from the lower left to the upper right in like a squiggly line. But to your point, in no given year does it return exactly 10%. Some years the stock market returns 20%, 25, 30%. In other years, the returns are minus 10%, minus 20%, minus 30%. So they are truly all over the map. This is why so many financial professionals, myself included, tell people don't put money that you need in the short term meaning 5 years, into the stock market. Anything can happen in the stock market over a 5 year period. You could double or triple your money over 5 years, but you could also suffer a 20, 30, or 40% decline. So if you know you're going to need that money for college or to buy a house or to buy a car, the stock market is not the right place to put that capital. However, if you measure the returns of the stock market over 10 or 20 or 30-year rolling periods, that's where you get that 10% annualized return from on average. The market has a way of basically going up at a relatively consistent rate when measured over long periods of time, but in any given year, the returns are effectively random.
So why is your book then called Why Does the Stock Market Go Up?
Well, I literally wrote the book because I myself didn't know the answer to that question. The funny thing about the stock market is, it intuitively made sense to me why the stock market went down. Right, like right now, what's happening in the world? Well, there's a war going on. Prices are rising like crazy. There's supply chain disruptions, and interest rates are on the rise. It doesn't take a lot of imagination to think that things aren't going great in the world right now. And when things are going poorly, it makes sense to me why that would result in the stock market going down. What never made sense to me was why the stock market went up in the first place. I also read a lot of wonderful books, and they said, yes, the stock market occasionally declines, but the stock market always recovers from declines, no matter how bad the world gets. And that's something that never made any sense to me at all. Why does the stock market seem to defy the laws of gravity and continually go up and up over time? The reason that happens is that the stock market is a collection of businesses, and businesses are out there and they are incentivized and out there trying to grow. Those businesses are constantly adding new customers, they're adding new products, and they're trying to improve their overall profitability. In doing so, in any given year, anything could happen to those companies' profits by and large. But when measured over long periods of time, there's a couple of macro things underlying them that gradually push those companies' profits as a group higher. And that is the thing that leads the stock market as a whole to not only recover from downturns, but to always go on and reach a new high. So that never made sense to me. And that is literally why I wrote the book, just because I think once you truly understand how the stock market works and why it delivers those returns, that you can actually invest confidently.
Absolutely. Something that I read as well is in the indexes, let's take the S&P 500 for example. If a company doesn't perform well, it's removed, right? It's removed from the S&P 500. So if you're buying S&P 500 indexes, which is representation, a little piece of all of those companies, that bad company is not going to be in there anymore. So it's like self-correcting, or even the Dow, right? We've seen what happened with GE. GE got pulled off of the Dow. It was there like from the beginning, and only recently, after 120 years or something, got pulled off of the Dow. So there's this self-correcting nature to the stock market, which that also helped me understand why it always goes up.
Yeah, very, very much so. So to your point, the S&P 500 has 500 companies in there, and every now and then, some new companies come public that are dynamic and growing, and other companies are lose their way and are going out of business, or bad things is happening. And every year or so, new companies are introduced to the S&P 500, and old bad companies are kicked out. So it is self cleansing. In any given year, it's not that big of a deal. Maybe it's like 5% or so of the companies that are in there actually change hands. But when you look at the difference between the S&P 500 today and then when I was born in the early 1980s, only a minority of companies that were there when I was born are still in there today. So the index does turn over time as the market continues to evolve and the economy continues to evolve. So that's one reason why investing in index funds like the S&P 500 is such a good idea for so many people, because you don't have to do any thinking. All of that happens for you automatically.
Who do you think should own stocks?
So I am a huge proponent of index funds. When people come up to me in everyday life and say, Brian, what should I invest in? My answer is always the same: index funds. Index funds are no thinking. You can set them up to be dollar cost average. It's incredibly easy to do so. It's incredibly low cost. And if you can do that for a period of many years, the odds of you doing extremely well over time are very high. However, if somebody has an interest in the stock market, the same way that I do, I actually think that there is merit in owning individual stocks on top of that. Figuring out what kind of stocks are interesting or should we buy doesn't require advanced math or advanced degree. The only thing that it really requires is interest on behalf of the investor to figure out how to read financial statements, to figure out how to read annual reports, to judge the management teams, to think through to business models, to learn about valuation and things like that. For most people, they have no interest in any of that stuff, which is perfectly fine, which is why I say for, let's say, 98% of the population, index funds are all they need to know. However, if you are in that 2% of people that are just weirdly fascinated by the stock market, such as I am, I do think that owning a group of individual stocks for long periods of time is a viable strategy.
Love that. Love that. It's interesting that we often have this debate, probably for no reason, indexes or individual stocks, when you can actually have both.
Yep, there's absolutely nothing wrong with both, and the nice thing about I would say Robinhood over the last couple of years, while there are plenty of flaws with it, is that Robinhood has helped introduce a whole group of people that have had no interest in investing to the stock market for the very first time. I can say that I first became interested in investing when I first learned about penny stocks back in the mid 2000s. They turned out to be horrendous investments, and I got my teeth kicked in with them because I had no idea what I was doing. But that did help to spark an interest in me learning about the stock market, and I have since just fallen in love with how the stock market works. So, for some people, owning individual stocks can be like kind of like a gateway drug to getting interested in the stock market, and then they learn maybe I should just index and call it a day. But if individual stocks help people learn about the stock market and get interested, I'm all for that.
So, how should people own stocks? Should they buy in Robinhood, like you just said, or what should they do?
Well, the easiest way that people get exposure to the stock market, especially in the United States, is through their company's 401k or through a retirement plan. Oftentimes, investing there first is the no-brainer thing to do because a lot of companies out there provide a company match. For example, some companies are like, if you invest $100, we'll give you $25 on top of that in extra buying power, and you also delay your taxes on any gains for doing so. that's a bit of a no-brainer. That extra capital that your employer kicks in is the closest thing to a free lunch as you're going to get in investing. Beyond that, there are also other types of funds that you can own stocks through, such as IRAs or Roth IRAs, which have some different tax characteristics depending on your individual situation. And then beyond that, after you've kind of taken advantage of your 401k and Roth or a traditional IRA, then I think with any extra capital, you should put that into the stock market through just a regular brokerage account, such as Robinhood or many of the brokers that are out there. So the manner in that you hold stocks does matter for tax purposes, but how you own them isn't as important as a decision to just invest in the first place.
Well said. So, Brian, what advice do you have for younger investors out there who have mostly pretty much known bull markets to this point?
Yeah, if you got started investing anytime after, let's say, April of 2020, which is when a whole bunch of new people for the very first time started to pay attention to the stock market because it was the only thing they can do, 2020 was an extremely weird year in investing. You could buy essentially anything, and that stock basically went up instantaneously. And a whole bunch of people learned that quote unquote investing in the stock market was a sure thing. What we've seen over the last year is the exact opposite of that, where it really doesn't matter what you buy, that thing is going to be going down. And a lot of investors are going through a bear market for the first time in their life. If you are a young investor and you have a multi-decade time horizon, a bear market is the best thing that could possibly happen to you. You should be rooting for stocks to go lower and lower and lower. If you're a net buyer of stocks, you want to get them at as low of a price as you possibly can. So while it's not psychologically fun to watch the value of your portfolio decline, if you're in accumulation mode, it's a wonderful thing for you to go through. So my advice to investors is to always start by educating yourself. If you just learned about Robinhood or stocks or investing through a Reddit board or through a friend or something like that, that's not enough information to get started. Listen to podcasts, read books, watch YouTube videos, and really do a good job of educating yourself about what the stock market is, how it works, and the time horizon that you need to keep in mind to own stocks successfully.
And I will take this opportunity to say, I totally think that your book, Why Does the Stock Market Go Up, is a great book for people to read. There's great stories in there. It's very relatable. It's not overwhelmingly numbers and calculations, right? Because that can, turn your brain off, like you said, Brian. So it's very relatable. What I loved, and I told you this before you were recording, the chapters are super short. They're like just a couple of pages long, which is great. It's sort of structured in a way where the titles of the chapters are questions. It's basically Brian's asking questions that you've probably had and maybe didn't know who to ask or didn't even know what the question was that you even had. So it's a great overview of the stock market. And I think, Brian, it'd be very hard to read your book and not feel empowered to go invest in the stock market.
Well, thank you for that. That was very intentional on my part. When I first started investing in the stock market was 2004. I vividly remember being at my company, and I was signing the papers and everything to get up and running. And one of those papers was like my 401k plan, and it said, "Do you want to invest in the high risk one, the medium risk one, or the low risk one?" And I looked at my HR person and said, "What do I choose?" And she said, "Oh, I'm not allowed to advise you on that." And I said, "Well, this seems like an important decision. I have no idea what I'm doing." And I just kind of went with the high risk one because that sounded the best to me. But I really think back to myself in that situation and how I had essentially just zero education about the stock market. And by the way, I say that as someone that just freshly graduated with a business degree, a degree in business, and I was still clueless about what the stock market was. So when I was writing the book, I very much kept my former self in mind and just saying, what do I wish that I could tell myself 20 years ago when I was signing those papers about the stock market that I needed to know? So that was how I wrote the book. It was designed for people that are literally starting from the ground floor with stocks and have questions just like I did.
Well, you nailed it. Absolutely. So is there anything else you'd like to add, Brian, before we wrap up?
Yeah, I will just say the stock market can seem boring. It can seem confusing. It can seem intimidating. It's not hard to understand the stock market and what it is once it's explained to you properly. You don't need advanced math. You can do it all with addition, subtraction, and division. So really take the time to educate yourself. It's one of the best investments you'll ever make.
Why don't you tell people how to get in touch with you?
Yeah, the easiest way to connect with me is on social media. I'm very active on Twitter. My name there is at Brian Feroldi. I also have a YouTube channel. That's my name, Brian Feroldi, where I go into the details for people that are interested in individual stocks, and I show you how to break down financial statements, read through S1s, and all that nerdy stuff that I was discussing before.
Awesome. So you guys, you can find me on Twitter at Adulting is Easy. You can email me at realadultingiseasy@gmail.com. Thanks again for listening, everybody. Hopefully, Brian and I have made adulting a little easier for you.